My name is Nick Redman, but I don't think you really care about all that. I think you prefer more to get straight into the most exciting part of the most exciting subject in business, adjusting journal entries. Today, I'll be explaining the theory and definition to this concept, as well as outlining the 4 scenarios where adjusting entries are required, and going through worked examples. Some may think that this topic is a bit boring. Can you believe that? So I thought the best way to make this interesting was to put over-the-top PowerPoint effects like a 10-year-old. The first thing to discuss is the theory behind adjusting entries. Adjusting entries are used under the accrual accounting method, in which you would enter them after constructing your trial balance at the end of each period. Essentially, the point of these entries is to get a better idea of your liabilities and asset balances at the end of each period. The 4 scenarios that adjusting entries are required for are as follows. Deferred revenue, in which you receive payment before performing a service. Accrued revenue, wherein you perform a service before payment. A deferred expense, which is paying before you incur an expense. And finally, an accrued expense, which involves paying after incurring an expense. Pretty riveting stuff, isn't it? The first scenario we have is a deferred revenue. Say that you get paid $5,000 for a service to be performed on Sunday, but the accounting period ends on a Thursday. In order to record this in the general journal, you simply debit cash and credit unearned revenue, increasing both your assets and liabilities as shown. The second part of this transaction would be in the next period to show the earning of this revenue, in which you would credit service revenue as an equity account, whilst debiting unearned revenue to erase the liability. If you're confused by now, well, you should have gone to that 8 a.m. lecture. Now let's imagine the same scenario, but you get paid after performing the service. Here you debit your receivables and asset account and credit service revenue, increasing assets and equity. When payment is received, you can enter an entry debiting cash and crediting your accounts receivable. Next we have a deferred expense, which in practice is similar to a deferred revenue. In this example, you pay $5,000 for an expense to be incurred later, for example rent. Here you debit a prepaid asset account, crediting cash as you have already paid for it. As you use this asset, you must adjust accordingly as shown to balance the asset and liability accounts. Finally, we have an accrued expense. Here, the company has recognized the expense, but it hasn't yet paid it. The most common types of accrued expense are interest and salaries payable, as shown. Here, you debit the expense to an expense account and credit the liability to salaries payable. When you pay your employees, you credit cash and debit the liability as shown. Now that you know how to do your adjusting entries, you can maybe scrape by with a pass in accounting. Yay!